This video will help you know about the tax on mutual fund dividends. So let us take this step by step and understand exactly how tax applies to mutual fund dividends, what changed in recent years, and what you as an investor need to keep in mind. The first thing to know is that mutual fund dividends are no longer called dividends. They have been officially renamed as IDCW, which stands for Income Distribution Cum Capital Withdrawal. Now, the rules around taxing this income have changed significantly over the years. Up until the financial year 2019 to 2020, the dividend received by an investor was completely tax-free in their hands. Instead, the mutual fund house itself used to pay something called a dividend distribution tax on behalf of the investor before passing on the money. However, starting from April 2020, this entire system was changed. The dividend distribution tax was removed for all mutual fund schemes. From that point onwards, the IDCW or mutual fund dividend became fully taxable in the hands of the investor, meaning the investor now has to pay tax on this income based on their own income tax slab rate. So what exactly does taxable in the hands of the investor mean in practice? It is quite straightforward. When a mutual fund scheme distributes IDCW to its unit holders, that amount is handed over directly to the investor. This IDCW amount then gets added on top of the investor's total annual income for that financial year. Once it is added to their total income, it is taxed at whatever income tax slab rate the investor falls under. So, if an investor is in the 30% tax bracket, the IDCW they receive will be taxed at 30%. If they are in a lower bracket, they pay less. Essentially, the tax treatment is the same as any other regular income they earn. Now, coming to an equally important concept, TDS, which stands for tax deducted at source on mutual fund dividends or IDCW. TDS is applicable for both resident ins and non-residents when they receive IDCW from a mutual fund scheme. Let us look at each category separately. For resident Indians, TDS is deducted at 10% on the dividend amount, but only if the total dividend received in a financial year exceeds 10,000 rupees. This rule comes under Section 194K of the Income Tax Act. Now, there is an important relief available here. If a resident investor's total annual income is below the taxable limit, meaning they do not have a tax liability at all, they have the option to submit Form 121 to the mutual fund. By submitting this form, they can request that TDS not be deducted on their IDCW income. For non-residents, the TDS rate is higher. It is 20%, and this is governed under Section 196A of the Income Tax Act. Let us now look at a practical example to make the TDS rules crystal clear. Consider Mr. A, who is a resident Indian and holds 1000 units of the XYZ mutual fund scheme. The scheme declares an IDCW of 7 rupees per unit. So the total dividend amount works out to 7 rupees multiplied by 1000 units, which gives us 7000 rupees. Now, since the total IDCW amount of 7000 rupees is below the threshold of 10,000 rupees, no TDS is applicable here. Mr. A receives the full 7,000 rupees without any deduction. TDS is nil in this case. Carrying forward the same example, let us now change the numbers slightly to see when TDS kicks in. Mr. A is again a resident Indian holding 1000 units of the XYZ mutual fund scheme. This time, the scheme declares an IDCW of 12 rupees per unit. So the total dividend becomes 12 rupees multiplied by 1000 units, which equals 12,000 rupees. Now, since this amount of 12,000 rupees is more than the 10,000 rupees threshold, TDS at the rate of 10% becomes applicable. 10% of 12,000 rupees works out to 1,200 rupees. This 1200 rupees is deducted as TDS before the money reaches the investor. So after the deduction, Mr. A actually receives 12,000 rupees minus 1200 rupees, which equals 10,800 rupees as his net IDCW. That is the actual amount that lands in his hands after tax.